there's a ceasefire between Israel and Iran. Last night, the S&P 500 was up about 1%. That leaves it less than 1% from an all-time high. I think we can interpret from that Wall Street has decided that the crisis in the Middle East is in the rearview mirror, and they can go back to focusing on earnings, valuations, the US economy, and interest rates. So let me start with valuations and earnings. All year long, I've been saying that US stocks are being supported by very strong earnings reporting. We had double-digit earnings growth reported earlier this year for the fourth quarter of last year. And then a few months ago, we had first quarter earnings reported, and once again, it was double-digit earnings growth. So now we're looking forward to the second quarter earnings reporting, and according to FactSet, S&P earnings are going to grow at a 4.9% rate. And since US companies have been outperforming Wall Street estimates substantially in the fourth quarter and the first quarter of this year, we might assume that that's going to happen again. So we can believe, or at least kind of estimate, that maybe we're going to get 7-8% earnings growth for the second quarter. That's strong enough to kind of keep Wall Street in a bullish frame of mind. So we're not going to get a sell-off while these companies are reporting good earnings, unless, of course, we have some bad economic data that make people think, going forward, these companies are going to have a hard time continuing to grow their earnings. According to the Atlanta Fed, their GDP now forecast, I have to look at my notes here, is that the US economy in the second quarter is going to be growing at a 3.4% rate. I think Wall Street economists are predicting it's going to be growing at a 2% rate, but they've been raising their estimates. So I think at the end of the day, we'll probably see the US economy growing in the second quarter of closer to 3% than 2%. So that's a good economy. That's got to keep people knowing that US companies are not going to have a great deal of trouble continuing to grow their earnings. And so that's got to keep the S&P 500 resilient. Fed Chair Jay Powell was testifying before Congress yesterday in the States, that's Tuesday, and he basically said that the Fed can hold off on cutting interest rates for a while to see the impact of the tariffs on inflation rate. But really, the latest inflation numbers indicate that the Fed already does have inflation under control. Most of the time, people kind of focus on year-on-year core inflation. But if you look at the last 3 months monthly CPI numbers, and you just annualize those, say what is really inflation running out right now, it's about 1.6%. You have a very big PCE number coming out on Friday. The expectation is that that's going to show core PCE going up 0.1% month on month. If that happens, it's the same thing. Quarterly PCE core inflation is going up at a 1.7%. That's below the Fed's target at 2%. So if we get that benign number, I think that Powell, given what he said, they're going to stick with their plan. They're not going to cut interest rates in July. There is no meeting in August, but the market will start pricing in aggressive rate cuts beginning in September. Already in September, the expectations are that we're going to have one rate cut. I think the odds of that are over 70% right now. The odds of 2 rate cuts before the year ends are high as well. And in fact, there's a 50% chance that we have 3 rate cuts before the year ends. My expectations are if we have that good PCE number, the market's got to start thinking 3 rate cuts are more likely than 2. That's the sort of thing that Wall Street bulls like hearing, and that should bring the market a little bit higher.